Deep value is an investment strategy known as buying business disasters. It is simple but it's counterintuitive idea. Under the right conditions, losing stocks with apparently falling businesses and uncertain future offer usually favorable investment prospects. Benjamin Graham believed that stocks' intrinsic value could be deducted through careful fundamental analysis of financial statements and business prospects, and that intrinsic value will be compared to the price available in the market. If the stock price traded at a sufficient discount to intrinsic value to provide a margin of safety, the stock could be purchased. Given the time, the market price would revert towards intrinsic value, at which time the stock should be sold. Where the intrinsic value exceeds the price or where it didn't offer sufficient margin of safety, the stock should be avoided. Graham's main strategy was to buy very cheap stocks that traded below liquidation value, which known as a net stocks. When Graham appeared before U.S. Senate Committee on Banking, he was asked by the chairman, how is it the undervalued stock returns to the fair value? Just for example, when you buy a stock for $10 and it's worth $30, and you take that position, and when you cannot realize until a lot of people decide it's worth $30, how does it work? By advertising, or what happens? Graham responded, there is one mystery for our business, and it is a mystery to me as well as to everybody else. We know from experience that eventually market catches up with the value, and it realizes in one way or another. Graham's response wasn't very satisfying, so here's perhaps a better answer. Over time, company results have tendency to regress to the mean, as underlying an economic force attracts new entrants to attractive markets and encourages participants to leave low-return businesses. Because of this tendency, companies that have been good performers in the past may prove to have inferior investments, while poor companies frequently provide superior investment return in the future. The good companies underperform because the market overestimates the future growth and future return on equity, and as a result, the economic force that pulls stock price back to its intrinsic value is so-called mean reversion. Study and research was done aiming on undervaluation and overvaluation using a variety of different metrics such as price to any fundamentals. They found that by selecting a portfolio of stocks that were mostly undervalued and selecting a portfolio of stocks that were mostly overvalued, and then examining the trend and the earnings per share, where the earnings for the most of the undervalued stocks were falling and the earnings for overvalued stocks were increasing previously to the portfolio was selected, then unusual thing happened. Earnings for overvalued portfolio start to slow down and earnings for undervalued portfolio start to increase. In the end, low growth undervalued portfolio outperformed high growth overvalued portfolio. An average person thinks that portfolio of high growth stocks will continue to grow, but in reality, the mean reversion is much more likely an outcome. Now, let me ask you a question. Suppose that John goes to the theater every Sunday, and now you know that he has a broken leg. Shouldn't you factor that into your analysis to determine if he will go to the theater this Sunday? Well, the answer is no, because we tend to find more broken legs than there really are. Especially utilizing this style of investing, all the company appears to have broken legs. Joel Greenblatt conducted an experiment in 2002 to see if a computer can be programmed to invest like a Warren Buffett. Greenblatt is a value investor and a Columbia University professor, has a long history of research and writing about value investing strategy. Greenblatt proposed to test a Buffett wonderful companies at fair prices as a quantitative strategy. Wonderful company was measured by return on capital, while fair price was determined by earning yield. Over 47 years tested from 1964 until 2011, portfolio with 30 stocks with the best combinations of earning yields and return on capital would have returned 13.9% per year, comparing to 10.5% for a market. The magic formula outperformed the market by 3.3% annually. The magic formula has outperformed, but what driven the returns to the magic formula? Is it really mimicking the Buffett's wonderful companies at fair prices strategy? Finding the first-class businesses with the first-class management? Or is it something else? Eager to know. Toby devolved the magic formula into two parts. return on capital, and earnings yield, and tested each independently over a full data period. The results were astonishing. Earnings yield alone was returning about 18% annually, while the return on capital was turning around 10% annually. Because of the earnings yield, the magic formula is so powerful. It beats the market consistently. Return on capital was pulling back earnings yield. That's why earnings yield alone is such a superior metric. Greenblatt's earnings yield, known generally as the enterprise multiple, occasionally as the acquirers multiple. Enterprise multiple can be simplified and calculated as follows. Enterprise multiple equal EBITDA or EBIT divided by enterprise value. Enterprise multiple outperform any metric out there, so the strategy is to choose a portfolio and find the stocks based on enterprise multiple metric. The more depressed the company, the better the outperformance. Also, a portfolio should have around 20 stocks. It's considered as well diversified, and there is really no benefits to buy more stocks than 20. Portfolio should also be rebalanced every year. So this was a summary of the book Deep Value Investing by Tobias Carlisle. It was an amazing read. I highly recommend to any investor, especially if you're a value investor. So if you guys have any question, please comment below, and thank you so much for watching.